Greetings and salutations. It is I, David Duford, at davidduford.com, where I recruit, and train agents to become top producing insurance professionals. Today, I'm actually going to do a basic overview training on the different types of final expense products that are out there. So I deal with a lot of new agents. Maybe you're watching this and you're brand new or thinking about jumping into the final expense business and you are learning about final expense, but maybe you see these terminologies like graded, level, standard, return of premium, and so on, and are kind of confused as to how the whole final expense product works. If that's the case, this is the video to watch, because what I'm going to do right now is really go into detail about how all this stuff works and give you the facts of how final expense is supposed to work. So first of all, final expense is what we call simplified issue whole life insurance. Let's break this down in a little bit more information so that you understand what that really means. So whole life insurance. What is whole life? Well, whole life is what Dave Ramsey hates, but we love it because whole life insurance lasts the whole life of the client's existence, as long as they pay the premium. This is important because we don't want to sell a policy to a client they could possibly outlive. I referenced the Dave Ramsey thing because term insurance is probably what you own. It's what probably most people own. And I think it's for good reason, although there are other products that are good reasons to own as well. But term insurance is not a good pick for our final expense clientele. Number one, a lot of prospects simply won't qualify for it. But number two, what if they outlive it? What if they outlive their coverage that they so desperately need to pay for their final expenses? So what most people agree to when it's explained to them this way is they need permanent protection that whole life provides. Also, whole life insurance never has rate increases due to age or health. So when I sit down and talk to a client, one of the benefits I tell my clients is that the premium I show them today is the premium it's always going to be. They don't have to wake up at 71 or 76 like they would with AARP or Globe Life Insurance and have a price increase that is 2 or 3 times as high as what it was just a month before their birthday. So this is a real problem. Why? Because seniors are paid on a fixed income. Their money doesn't go up by 2 or 3 times. It's fixed. Fixed meaning it ain't going anywhere. So the more predictability you have in premium pricing, the better adherence you're going to have for people to keep their policies, which is the whole point in owning this, right? And then the last thing is, hell, we don't know when we're going to die. It could be tomorrow. It could be in years from now. So why pick a plan you could outlive? It doesn't make any sense. So the act of death is guaranteed, but the occurrence of when it happens is not. And the only way to solve for that problem, besides having money set aside, which is unrealistic for our clientele since they're on a low income, is a whole life product because of its long-term, never-ending amount of coverage. It's also what's called simplified issue. And what that means with the final expense business is there's no traditional underwriting required, no examinations, no blood withdrawals, don't have to pee in a cup, don't have to run on a treadmill or take a EKG, none of that stuff. No doctor's records, no gophering around as an agent trying to get all this stuff tracked down. You simply ask questions, submit an electronic app, or do a verbal phone authorization that takes 10 to 15 minutes and get a decision approved or otherwise. The goal with these products is to keep them simple, to end the call at the end of the call so you never have to come back because the policy has been approved. This is what we want and what our clients need. And the simplified issue whole life product provides that. Now, kind of building on that, there's some terminology you also need to know as a new agent that is important as well. You're going to hear terms like simplified, level, preferred, standard, graded, guaranteed issue, return of premium. What does all this mean? So let's talk about that briefly. The goal you should have as a final expense agent is to write not only a simplified issue whole life product on your client, but to also write a first day full coverage product. Now, what does that mean? That means if your client kicks the bucket after the first payment is made, if everything was done accordingly, there's been no misrepresentation, then the client's beneficiary gets paid the full death benefit, whether they die from natural death or accidental death. This is the type of plan that gives full and total peace of mind. That means for any reason the client dies, they get run over by a car, they have a stroke, they get cancer, just think of any natural causes or accidental causes. This plan provides total peace of mind and protection. That is the ideal. Now, there's different ways to describe this. You could have what's called level plan. That's what we described. That's what that means. You may also see it referred to as first day full coverage. Exactly the same thing. Also, preferred or standard pricing. That means first day full natural and accidental death coverage, but at a preferred pricing or a higher price standard pricing. Okay, certain carriers have that distinction sometimes. Again, this is the ideal of where we want to place our clients. But what happens if they have pre-existing health issues that may limit the options available for coverage? This is where we have graded plans, guaranteed issue plans, and modified plans. So let me describe how that works. Out of all of those I've described, probably most commonly what you'll write are guaranteed issue plans. These are still simplified issue whole life plans, just all the same as I've described, with some important distinctions. Number one, there's no health questions asked. It's guaranteed to be issued. So if there's a health issue, your other level-based plans cannot cover because the health questions are there. Then this will be a good trump card, as we like to call it. When all else fails, you pull this one out of the bag in order to get your client approved. Literally, if they can sign their name, they're guaranteed to be approved. Well, that sounds easy, Dave. What's the downside? Well, the downside is your client is not fully protected for natural causes of death until 2 years have passed. The only way it is going to pay out is if they get run over by a car or die from an accident in the first year, because it is fully covered 100% for accidental causes. But for natural causes, what I would argue is the most important coverage in most guaranteed issue cases is not covered until 2 years have passed. Sometimes it's 3 years, but the ones we like writing the most are 2 years. Now, other than that, it's all the same. The rates never go up. The coverage never cancels due to age or health. It's just that there's this limitation of coverage. Now, if the client dies within the first 2 years, typically with most guaranteed issue products, the premiums are paid back to the client or the beneficiary. You can't take the money when you're dead. Or plus a 10% bonus on the premiums paid in. So it's a little better than putting it in a savings account. Sometimes that's a rebuttal to the objection we use. Why don't I just put it away in the savings? And it makes a big difference and puts a lot of ease to the client, like, oh, I'm not going to lose that money. I'm going to get it back. Now, modified return of premium is exactly the same as what I've described, the 2 or 3 year waiting period with premiums returned plus an additional interest amount, usually 10%, except modified return of premium typically refers to some minimal underwriting, some health questions. I personally prefer to just write guaranteed issue, less hassle, but accomplishes the same thing. And many times it's better priced. And then lastly here, graded. That just means you get partial coverage in the first and or second year so that you get a little bit of something from the get-go, certainly by the second year, which sometimes can be more advantageous than just a 2 year waiting period product. So that's the rundown of the basics of how final expense works and the different pricing, the different types of plans, how it's covered, and what situations you would use them. I guess the last thing I could add here is riders. Some people ask, well, what kind of riders can you add? I've never been a big rider type of agent. You could write accidental death coverage or grandchild coverage. It's actually probably a pretty good one to write. But I just always kept it simple. Here's your death benefit coverage. Here's what you pay for it. Which one do you want? So we can get granular in the riders. But the main important thing is getting the most coverage, the most comprehensive coverage for your client. And ideally, as I prefer, to be an independent agent to shop the carriers to see who's going to give you the best pick. And that's what I do with agents that join my agency. Again, I do recruit and train agents nationally, coast to coast, in becoming masters at selling final expense life insurance. And if you're thinking about getting into this business, if you're thinking about getting licensed, maybe you're already licensed, but you're with one of those Kool-Aid drinking MLM fests and you're tired of the rah-rah and the BS, and you want a real agency that focuses on you developing your skill set and becoming a master agent, then here's what you need to do. Go to daviddufour.com. Click the stuff that says become an agent. Learn more about becoming an agent. You can't help but to not see it on the website. It plastered everywhere. And you'll get some information to learn more about how to become an agent and participate in my training and development to make you become something better than you are now when it comes to selling final expense. I do hope you enjoyed this training. Hope it answers some basic questions about how final expense works. If you got any questions, comments, or anything, leave them below. Certainly subscribe if you haven't. And thank you for listening. We'll see you later. Bye.